it is because of a guideline that RBI has made it mandatory for all the commercial banks to follow. Second item is your investment. Bank also makes certain investment in various financial instruments. So those investments are basically part of your assets, advances, fixed asset. These are basically general details of various items. So like here bank may have certain cash, bank will have certain balance with RBI. So this item we are talking about, bank may have balance with the other bank. So this item we are talking about, call and short money. This is other bank. So basically all these are your part of assets of any commercial bank that we see in India or globally. And when it comes to investment, as we know that every bank has to do certain investment in SLR or government security based investment. So those investments are basically classified under government or approved security, and these approved security basically approved by RBI, and it will be considered as part of SLR, because all the commercial bank has to maintain certain level of securities or certain level of cash equivalent investment in terms of SLR requirement. So those are basically a kind of these type of security are part of that, and this security will be identified and and notified by the RBI. If banks are purchasing other type of securities, then it will be classified as non-approved security and it won't be considered under the SLR. There are classification. Now coming back to loan and advances, when we talk about loan and advances, cash credit and overdraft facility, it is provided by the bank. Purchase and discount of commercial bills. Basically, this is similar to your factoring services or factoring bill discounting or factoring, and demand and term loans. These are basically the various loan and advances for commercial bank. And here what we have is over the period of almost 60 years in US, what kind of portfolio commercial on an average commercial banks had. Here you can see initially most of the most of the assets were in terms of investment in securities, whether and this security includes Federal Reserve security the way we have in India, or other non-approved securities. Because from 1951 to 2010, there were various shifts or regime changes in US as well. Like RBI keep changing various guidelines. So this is a combinational impact on bank portfolio holding or bank asset holding we can call. And here you can see around initially your securities were high, and then because of there was a act by Dodd-Frank, we call it Dodd-Frank Act. What that act was, that act restricts banks making high level of investment in securities. Security means non-approved securities we are talking about. And if I'm not wrong, this act came around 2013 or so. So what this act has done, this act has restricted banks not to actively participate in buying and selling non-approved securities. And the reason why, because basically when these all the banks have those having lots of cash in hand, and that cash is being used in security buying and selling, that influence the market. To restrict that, and because risk is also there for the banks, to restrict that, this kind of act was introduced. And I believe there were also similar kind of act, and that is resulting as this kind of delay, this reduction in a non-approved or approved securities in US. And when it comes to business loan, you can see that generally business loan follows certain pattern, and that pattern here you can see initially it was low, then around 70 75 it seems there were lots of investment, and that's why many corporation may have come forward and taken business loan. And then subsequently here you may observe that when debt market or other alternative market becomes stronger, then dependency on business loan become becomes less attractive for the corporations. So basically, this kind of diagram or this kind of graph can tell you about the insights about lending and borrowing activity in any economy. And of course, here the interesting part is mortgage. If you see, it has really gone up continuously. Mortgage. It means people are basically coming forward, buying real assets or buying properties and taking loan from the banks. So that is at least good part. And when it comes to various innovation that we see in terms of online transaction, so various facilities are nowadays available. NEFT, we call it National Electronic Fund Transfer, RTGS. This is real-time gross settlement, and IMPS is interbank mobile payment services. And also now we have other like these are basically totally bank driven innovation, online transaction. Now we have other form of your wallet banking or online payment banking kind of system, that is also directly indirectly follows these type of transaction. And when we are seeing these transactions having certain differences. For example, when we talk about IMPS, so here you can see there is certain cap on maximum amount that you can do you can do transaction, and it is in the immediate transfer of your fund. Whereas when we talk about NEFT, it is processed in batches, and that batch are classified based on when you have initiated this process, or when you have basically transferred certain amount to the beneficiary's account. So these are basically a new innovation that we are seeing in last 7-8 years in India, and these has really pushed economy up to large extent, and it has really resulted as good you know uh, new innovation in other market as well. Now, whenever it comes to bank lending, you will find two kind of theories. Because this is the core activity of bank. Unless bank performs lending activity, your bank cannot survive. Bank will have to go and lend money to the borrower, and using the interest on the lending amount, bank will ensure that they can sustain for a long time. So one theory is liquidity approach or liquidity based theory, or liquidation approach we can call. So what this approach suggests, this approach is basically looks at the short term conditions. So why we are calling short term? Because according to this approach, banks are going to look at the current position of borrower, or what kind of asset borrowers having. If borrower having quality asset as collateral, then bank generally review their quality of asset and other condition and gives loan to them. And why we are calling it short term? Because it is based on quality of asset, not the various reputation and relationship with the borrower. Those kind of techniques are in you will find even in today's in the present scenario. Most of the time, bank will ask this kind of bank will follow this kind of approach, where bank will ensure that borrower having quality asset, and in case of any payment default, those assets can be taken by the bank, and then whatever the formalities are there, liquidation formalities, those can be initiated. So this is one part of the lending theory, and second theory is based on going concern approach. So going concern in accounting, if you remember, when we say going concern, it means going concern concept related to a company or corporation. It suggests that when corporations are created, they are going to operate over the long run. Means you can assume that any company's life is going to be infinite. Means it will keep on operating. It is not going to close. It means if that kind of condition is there, it means company will keep on earning cash flows, or keep on doing business. If company is able to keep on doing business, then company will have certain cash flows. If cash flows are there, and then looking at the firm's cash flow rather than asset, loans can be given. So in this, generally you will find assets are asset quality as collateral are main basis for issuing or for lending. When any borrower approaches to the bank will check type of asset you are holding or borrower is holding, can that be considered as collateral, and then loans are given. Whereas in case of going concern, you will find rather than looking at the immediate or asset, but focus would be more on what kind of future cash flow opportunities or future cash flow will be there for the borrower. And if you and so generally this kind of approach is used when any retail borrower or any individual approaches to the bank. Whereas in going concern, generally corporations, when corporate approach to the bank, they follow this kind of approach. So that's why I said there are mixed approach, the short term and long term, and looking at the type of borrower, bank decide their criteria for sanctioning the loan. And as you know, loan can be of two types. One where there is a backup of security or collateral based loan, and second is non-collateral based loan. So when you have collateral based loan, we call it secured loan, and when it is non-collateral based, we call it unsecured loan. And there is a concept of margin. So what is margin basically? Margin basically what is the gap between value of asset and amount of amount of loan. Basically, why this concept is important, because many times you will find that when you approach to the bank and you say, I have, let's say, a piece of land worth is, let's say, 1 crore, and you wanted to take loan of, let's say, equal amount. So this much amount of loan you were expecting from the bank, saying that I have worth of this much land, so can I get loan from your bank? But because banks also want to make themselves at safer side. So what they will do, they'll say, we cannot provide you loan, because as you are saying that value of your land, market value of land seems to be 1 crore, but we cannot provide you loan of 1 crore on this particular asset. We will only provide you loan up to maximum of 70 lakhs. And this is happens. So it means there is a gap between whatever collateral you are attaching to this particular loan, and whatever amount bank will be lending to you. So this gap of between these two is nothing but the margin. Why banks keep margin? Basically, this 30 lakhs is a kind of buffer for the bank. In case value of your land comes down, or value of basically land is nothing but a kind of asset. If value of this asset comes down in certain condition, at least bank should not suffer. Here assumption is that your borrower may default to pay back to the bank, and that's why this kind of margin concept is there. And again, margin depends upon what kind of assets we are considering as a collateral. For example, when we talk about gold or this kind of precious metal, you can take up to 10% of the margin, could be up to 10%. It means if you have gold of worth rupee 1 lakh, loan can be given up to 90,000. So 10% margin will be there. And when it comes to other security, for example, if you look at the ordinary share, you see around, based on the type of share you are having ownership, it may vary from 40% to 50%. It means if you have, let's say, portfolio of securities and that worth is of 50,000, and if bank says we will keep our margin at 25%, or sorry, at 50%. It means maximum loan that you can avail using these security as collateral is of 25,000. And this helps up to large extent to the bank, that your all these borrowings won't convert into NPA, or in case it converts, bank is not going to suffer. So this is what your Bank of India balance sheet in last in 2015 and 16 we have already seen. So these are not required, and these are additional items in balance sheet. But if you know balance sheet, you can easily relate to the bank, to any commercial bank. Now coming back to type of performance measure, because at the end uh, we have discussed what type of activity commercial bank does, how they allow lending and borrowing activity. Now there are certain measures that can be used to calculate the performance of banks. One of the measure is return on asset. By name itself, we are talking about how much return banks assets that are part of balance sheet given in a given year. Another ratio is return on equity. So basically equity capital, how much return, because ultimately bank is going to utilize all these assets or equity capital for various activities. So how those assets or equity capital has been utilized in last 1 year, that is captured through return on equity. And there is a relationship between return on equity. Anyway, if you use these two formula through equity multiplier, basically what is equity multiplier? Your total asset divided by total equity. We call it equity multiplier. How many times your assets have gone up when equity is used. So let's see, what kind of trend was there in US. If you see, these are the trend of return on asset for, this is basically average return on asset of commercial banks in US. So all commercial bank, and then ROA was calculated, and for every year, average ROAs are presented in this particular graph. So in this region, you can easily see, there are, impact on banking system. And if you re-look at this, this was the period of 2007 and sorry, 2007-2009 period. And when this global crisis happened. And if you look at the reason for global crisis was the your real asset market, real asset, or you can mortgage. And when we have looked at previous slide, where we have seen what kind of portfolio US based commercial bank were maintaining over 1951 to 2010. There we have seen that most of the time here, if you see this, there was lots of loans, mortgage based loans were there. And why loans were issued? Because bank assumed that worth of or quality of those real estate property were good. But it was not the case. There was some kind of bubble, or there was some kind of a problem with the quality of asset. And that is one of the reason why we are seeing a serious, you see it went up to around a negative 40 basis point ROA. And let's look at the return on equity. And here return on equity, we have various small to big banks here. You can see all the bank, and then various other classifications. So what we are observing here is more or less same kind of relationship that we have observed in case of return on asset. Here also we observe a decline, and that decline we can easily relate to the macro event. And if bank having most of the loans in terms of mortgage, of course, because this crisis was initiated because of a mortgage or real estate prices. So that impact is very much visible here. Any question so far? Now let's look at the as of now, what are the top 10 commercial banks across the world? So most of the banks you will find are Chinese. So this bank, yeah, again, Industrial and Commercial Bank of China Limited. And if you look at the market cap is 231 billion US dollar, and net income is around 45 billion. And when you compare this with bank in this is the JP Morgan, US based bank, that comes to second in terms of revenue, whereas in terms of market cap, this bank is bigger than this Chinese bank. So you can see and in top 10 you won't find any Indian banks. Of course, SBI and these banks are doing well, but they are not in top 10 banks in terms of their asset holding or in terms of their business activities. So apart from ROA and ROE, there are other proxies that can be used to calculate the performance of the bank. One is the net interest margin. So what is net interest margin? Basically, net interest margin is coming from bank's core activity, because what bank is doing, bank is giving loan and bank having deposit. So when loans are given, bank will earn, so bank will get interest because loans are given. When deposits are there, bank will have to provide interest to the borrower, to the depositor. So it means this is a inflow for the bank and this is the outflow, because these two are the item based on interest rate on which bank earns money or makes profit. So here net interest margin basically is the difference between total interest that bank is going to earn. It is coming from where? It is majorly coming from loan issued, and that's why loans are classified as assets. Similarly, bank, if deposits are there, bank will be paying interest on that. So this is basically liability for the bank. Another ratio is loan loss ratio, because many times you will find no loans are given, but bank is not able to recover. So basically how much provision bank has made, because probability is always there that most of the loans may turn into bad loans. So what kind of provisions are made? The bank also makes provision, means what kind of safety net bank has created. So generally provisions are made within the balance sheet. You can easily identify. So how much amount is kept for loan losses and divided by total loan losses. So if it is high, it means bank is more, what you call, more vulnerable towards the bank loan, and that's why more provisions are made. Similarly, loan ratio, net loan, and this tells about the activity. Loan ratio means net loan. Net loan means any given year how much amount of loan is given divided by total loan. If this is high, it means bank has done a good job because more loans were given and these loans are going to bring more income for the bank. Another proxy is temporary investment ratio. So what temporary investments we are looking at? Basically, investment on SLR based security. If you look at government securities, investment security with maturity of less year or so, basically these are your treasury bill kind of security, treasury bills, and this is some kind of due or loans, interbank loans given, because when any bank having excess capital, that can be given to other banks. And if you remember, we had MSS, market stabilization scheme, where excess liquidity can be given to other banks. So these are basically a kind of investment for bank, because bank will earn return on this. So this is how, if this is high, it means bank having excess capital and that capital has been invested in these security. So we expect a high, or as a manager of a bank, we can expect that if this investment is high, that will add value, or that will show good performance of that bank. Volatility liability dependency ratio, basically how much volatility is there in terms of liability and investment that bank has made. It should be low ideally, because bank don't want high level of volatility. Bank wants a stable operation, whether it is related to investment or it is related to change in the liability. So this is how we can calculate it. Total volatility, volatile liabilities minus temporary investment. Temporary investment is basically we are looking at this kind of investment where these securities are more or less approved by the RBI for trading. And rupee gap ratio, this is again rupee gap is it is related to the interest rate. So interest rate on sensitive assets are can be classified as sensitive. We will see in subsequent slide sensitive versus non-sensitive asset. So how sensitive difference interest earn on sensitive asset and interest paid on sensitive liabilities. The difference between these two divided by total asset. If you remember, this talks about sensitive asset and liability, whereas when we talk about net interest margin, it does not differentiate among the quality of assets or quality of items. So this is the main difference between two. And whenever we talk about commercial bank, we always think about non-performing asset or loan losses. This becomes basically loan losses. So as per the current norm, you will find we are current norm means we are not considering specific provisions, because during the COVID there were various provisions were made for related to NPA. So we are ignoring that exceptional part. In general, if any payment is due more than 19 days, then it is converted into NPA, non-performing asset, and then banks put in the non-performing asset list, and then follow-ups are done based on the current prevailing guidelines. So this is for loans which are non-agriculture loan. But when it comes for agriculture loan, if it is due for 2 crop season, then it is going to be considered. Or basically 2 crop season, generally you will find more or less 1 year, 12 months time period is given. So if farmer is not able to do it, then based on the type of loan given, it can be converted into NPA, and then bank start following their guidelines for recovery. Now these are the whenever we looked at asset from their characteristics. So these are the various classification of assets from bank point of view. Standard asset, whenever we call it a standard asset, so these are asset where is no problem, means those assets can be attached for any kind of loan. And a substandard assets, so an asset that would be classified, sir, if remain NPA for a period less than or equal to 12 months. So here such assets should not be NPA. If assets are standard, means these are not under any collateral and not that loan or that borrower is not into NPA account. When we call it substandard asset, it means if those assets that are remain NPA, non-performing asset, for a period of 90 days and up to 12 months. Doubtful asset, because assets are basically collateral. You think about asset as collateral. Why collateral? Because if loans are given, those loans basically are backed up or secured by these assets. So that kind of connection you establish whenever you are referring to various asset classes. Doubtful asset, an asset which is required to be classified doubtful if it has NPA more than 12 months. And loss asset means when recovery itself. So asset where loss has been identified, because once loss of loan has been identified, then it should be either adjusted, because if bank knows that this cannot be, this given loan cannot be recovered, because asset quality or collateral that borrower has attached, that is insufficient. So in that case, because bank cannot keep all NPA in their balance sheet for infinite lifetime, because if it keeps on doing, then size of balance sheet in terms of liability or asset, because if loans are not classified and written off or removed from the balance sheet, it will keep on going. And that's why many times bailout or some kind of special packages are given to the banks. Why? So that these kind of losses or loans that converted into NPA can be written off, because unless it is written off or cleared from the balance sheet, it will keep on reflecting and it will impact the performance of the bank. And that's why this kind of, yeah, hello.
Sir, I didn't understand this meaning of being written off.
So written off means, yeah, let's say certain NPA are identified, means bank knows that these kind of loans cannot be paid back by the borrower, right? And asset qualities are also not good. So what happens? The bank has to mention in their balance sheet or in their statement that this kind of loans or this kind of loan which was issued and asset attached to that or collateral attached to that cannot be sufficient enough for repayment. Repayment means returning amount back to the bank. So those assets are classified as loss asset, and these assets will be shown in the balance sheet of the bank, because loss means, let's say bank has given loan of 2 crore to someone and certain assets were attached, and now loans were not paid first. If not, if until it is paid, so it will be standard asset. Then If it is not paid and the quality of assets are not that much good, then it will keep on changing asset quality. And in this situation, in the loss asset, when bank decides that now this loan cannot be recovered, because loans are asset for the bank. If loan cannot be recovered, then it has to be, over the period of time, it has to be adjusted. So before that adjustment, or before clearing off from the balance sheet, unless once it is cleared off, means some kind of package is given to the bank, and clearing that NPA, it will be classified as loss asset, because loan given by the bank is not going to be recovered, and that's why that loan or that asset is being called as loss asset. And after that bank will initiate process of recovery. If because and if that recovery cannot happen, then bank call your commercial bank will request RBI to write off, to remove that NPA from bank's balance sheet. Because for example, if you see, if any bank had in 2010 amount of NPA of, let's say, 200 crore, and these NPA, let's say, are classified as loss asset, means it is not going to be paid back. Bank cannot expect to receive loan amount with interest coming back from the borrower. So this is the NPA. But if bank keep on bank keep on putting this NPA up to 2021, then in between period there will be also certain amount of NPA. So accumulated amount would be very large. So what generally happens, once bank decides that now this NPA, this loan that were given cannot be recovered, and they identify all 200 crore as loss asset or loan that are not going to cannot be recovered, then so two options left. Bank can go for liquidation, liquidation of assets. Assets means whatever collateral were attached. If that cannot help to recover this much amount, then request will be made by the bank to the RBI for special package, so that this should not be carrying up to infinite time period. Let's say in RBI, some packages are given. So what will happen in 2000, let's say hypothetically we assume in 2013 approval were given, and all these NPAs that were there up to 2010 are written off, means these are going to be cleared. Why cleared back? Because some kind of relief packages are given to those banks, and then it is going to be cleared from the balance sheet of banks. So this is how this kind of process happens. Otherwise, all banks will always have NPA, whether NPA was identified in 2000 or 2010, right? So
Okay.
any other question? Yes, because this is the classification. You can assume that all these assets are nothing but your loans. Standard loan means they are not classified as NPA. Substandard loan means when NPA for period of less than 12 months. Doubtful asset means when it is more than 12 months, means your interest and principal amount was not paid by the borrower, and when bank confirms that now this is the time, we are sure that borrower is not going to pay back taken amount, then it will be classified as loss asset. It will remain in the balance sheet but classified as loss asset. And then after that, with the approval, liquidation of asset, which are if attached to this particular loan, or some kind of special provision will be requested by the RBI through these banks, so that this kind of loss asset can be cleared from the balance sheet. Otherwise, it will always inflate balance sheet.
But then why not classify the loss asset as a liability up until the RBI clears it?
Yeah, it will be. That's why once assets are classified as loss asset, unless it is written off or with some kind of package it is cleared through the approval of RBI, it will be reflecting in the balance sheet. See, you cannot classify loss asset as, because loans are basically assets. We cannot classify as per the bank's balance sheet. We cannot classify loan given to the borrower as liability.
Okay, sir.
Yeah, means that is, that's why I started our discussion on these items after the balance sheet items, so that we can easily see how your corporation or any corporation's balance sheet is different from bank's balance sheet. Because you can think of, if lots of loans were given, and those loans becomes NPA, it will be an asset. It will show in the balance sheet as an asset, but bank is not able to even get a single cent as interest from the borrower. So that is the problem, and that's why unless assets or these loans are classified as loss asset, further process cannot be taken place, whether writing off from the balance sheet, or going for various procedure to liquidate the collateral attached, or recover these loans. So we will stop our discussion here. We have few more slides, especially related to vessel norms. So we will continue our discussion in next week. Yeah, so if you have any other question, we can take. Otherwise, we will close our session for today. Any question? Because this is especially commercial bank or banking system is very big topic. As much as you read, you will have always new insights, and it's very dynamic. RBI every quarter they are meeting, they are changing various guidelines. So you may find certain things that we discuss in this quarter probably may not be prevailing in coming quarter. So that's why banking system, or when we talk about any topic related to banks, are very dynamic. You will have to keep reading so that you can make yourself updated with those guidelines. Fine, so we are closing today's session, and if you have any query, any additional question, you can write back, or in next week you can keep your question for next week. We will come back and discuss. Thank you.